Hello, everyone, and welcome to ACECRT's October webinar. We are excited to bring to you the Guide to the Markets and Economy Quarter 4 presentation presented by Dr. David Kelly. David is the Chief Global Strategist and Head of the Global Market Insight Strategy Team for JP Morgan Funds. With over 20 years of experience, David provides valuable insight and perspective on the economy and markets. He is a keynote speaker at many national conferences and a frequent guest on CNBC, as well as other financial news outlets. David is a CFA charter holder. He also has a PhD and MA in economics from Michigan State University and a BA in economics from University College Dublin in the Republic of Ireland. And now on to the webinar.
It's not been a good year, it wasn't a good quarter. The markets were basically flat for the first 6 months of the year and then took a nasty dip. I think it's very important, though, to talk about why the markets fell in the third quarter and what does it say for investing from here. And so to do that, I want to use some slides from our new guide to the markets. And in particular, I want to talk about what happened in terms of returns so far this year. I want to talk about the uncertainty that I think is behind it, uncertainty about what's going on in China and what that means for EM and commodity markets and the ripple effects from that. And then uncertainty about the Federal Reserve and how and when they're going to raise interest rates. But also I think it's important to look a little deeper, look at China and really ask, is the China slowdown, first of all, how deep does it go, how much of a threat there is, but also what does it really mean for developed economies. I want to talk about the U.S. economy itself. I know the Federal Reserve is nervous about it, but should they be nervous about it? It's just an economy would expect this kind of economy. And then point out some opportunities we see in markets right now. People are always looking for opportunities. They know what a down market is, a buying opportunity. That's when you can get the best assets at the cheapest prices. And this is a good time to think about that. I think it's a good place to 65. Look at the ugliness of the year so far. If you go 3 columns in from the right-hand side of page 55, you see year-to-date returns. We always know it's been a bad year if cash is one of the best asset classes, and indeed it is. High yield is down on a year-to-date basis and had a very high quarter. A diversified portfolio is actually, down, but it's not a disaster. Equities in the United States and in other developed countries, particularly equities in emerging markets and commodities, are down double digits year-to-date. Now, why is this? I think the commodities and emerging market problem is clearly a lot to do with China. I think the U.S. equity problem actually has a lot to do with the Federal Reserve. But let's look at these issues separately. On the left-hand side of page 49, we show growth. GDP growth has been slowing since 2010. 10.4, 9.3, 7.8, 7.7, 7.4, 7.0. I'm not buying it. I think that the slowdown is far more severe than that. And the reason we think the slowdown is more severe than that is really on page 50. If you look at page 50, these are the cyclical sectors. We've got page 19 of the guide where we show U.S. cyclical sectors. Well, here are some cyclical sectors for China. First of all, vehicle sales. Vehicle sales have been absolutely booming. I mean, they've gone from 14 million vehicles annualized in 2011 up to about 20 million vehicles per year in 2014. And now they have peaked and they've slid to about 18.8 million vehicles in August of this year. There is clearly a slowdown in vehicle sales, and I think that is a very good sign of what's going on with the consumer sector of the economy. That's one of the cyclical sectors. Another very important sector for China is building, home building. We have seen an enormous pickup in apartments. You know all the stories about ghost cities. China was investing too much money in residential construction. Home prices were falling. Now, the good news is home prices seem to have stabilized, but the bad news is that home building itself, and they measure that by private residential floor space put in place, is down 18% year over year in August, and it's been down year over year throughout this year. That's a big slowdown in a big sector of the Chinese economy. Another big sector of the Chinese economy is on the bottom right, the export sector. I mean, China had been an export powerhouse, but as of August, exports down 5.5% year over year, imports down even more. But even with the increase in the value of the renminbi, that's a serious problem with exports down. And then if you look at the top right-hand side, you can see the Caixin PMI indices. They used to be called the market PMI indices for services and manufacturing. And you can see the big slide of manufacturing. Now, again, I want to moderate this a little bit by saying the services sector, which of course is more important than manufacturing in China and around the world, is still growing in China. But when I look at page 50, when I look at other things like electricity production, it's very hard for me to believe that China is really growing at 7% or even 6% or even 5%. And so I think one problem we have, I think one of the things that's contributing to the unease in global financial markets is the sense that China is slowing down more than China is saying. It's a way of how do you manage an economy, how do you manage information coming out of the economy. And I hope that over time, the Chinese government will really work on its economic statistics, just tell it like it is. Because in the end, I think economies do better if you tell people how it really is. But having said all of that, I don't think people should overreact to China. China is not collapsing. You know, if you turn back to page 49, you can see, for example, look at China's foreign exchange reserves, $3.6 trillion. You know, the renminbi is too high, actually. It's tied or has been on a quasi-peg to the US dollar. It got too high. The Chinese decided to try and revalue their currency downwards, and that caused a lot of instability, and then they stopped. But China has got the foreign reserves to manipulate its currency if it wants. It can bring it down or it might leave it there. They don't have to worry about a run on the currency that they can't control. They've got too many foreign exchange reserves and too much in their capital control for that to happen. In addition, they've got monetary policy tools. They could cut reserve requirements, which are very high. They could cut interest rates, which are still quite high, if they want to stimulate the economy. I do think that the Chinese leadership is somewhat torn over this issue. They do want to keep the economy growing at a steady pace, and they do want to keep the population happy and make sure that people feel comfortable about economic progress. At the same time, they realize that in the long run, China has to move from being a manufacturing, export-intensive economy to being one in which the services sector and the consumer sector does better. And that transition is helping slow the economy. One thing they could do tomorrow to speed up their economy, and indeed to speed up the global economy, is they could go to another bout of infrastructure spending in China. And they could do that. But if they did that, they would in some ways be building up a problem of more debt and more excess capacity for the years ahead. So they have the capability, I think, of preventing a meltdown. There's no China syndrome here. But at the same time, I think the Chinese government will allow the Chinese economy to gradually slow. If you're buying A shares in Shanghai, then maybe that's an issue. If you're invested in global stocks and in global bonds as a U.S. investor, it's not so much of an issue. The real issue is what does it mean for the rest of the world? If you look at page 45 of the guide, you can see, I think, clearly what the ramifications of Chinese slowdown are. There are, I would say, four sets of countries to think about. First of all, there are the commodity-producing emerging markets, countries like Russia and Brazil. If you look at page 45 of the Guide to the Markets, you can see that Russia and Brazil, they export a fair amount of their GDP to China. And the drop in commodity prices that has resulted from the Chinese slowdown and excess capacity is really hurting the Brazilian and the Russian economy severely. They're both basically in recession. It's also hurting economies like Chile among emerging markets and other emerging commodity producers. It is less important, though, if you look at the Indian economy. India exports just a very small fraction of GDP to China, and India is also a big commodity importer and is actually a beneficiary from lower commodity prices. It's less important for Mexico. So there are some emerging markets in the commodity space which are getting hurt, but there are some other emerging markets which aren't as dependent upon China and aren't commodity exporters who are not being hurt badly. In addition, another area to look at are the countries that surround China and are tied into China's manufacturing engine. In particular, Taiwan, Korea, and Singapore. You can look at Korea is a big exporter to China, and they clearly are getting hurt by the slowdown in China. That's also true for Taiwan, even more so for Taiwan, for Hong Kong and Singapore. So they are getting hurt. And there are developed countries, Canada and Australia, which are getting hurt, but they're not actually getting hurt that much. It's hurting manufacturing in those countries, it's hurting commodity producers, but there's more than one string to the bow, so to speak, for both Canada and Australia. And we think that both of those countries are going to actually bounce back in Q3 in terms of GDP growth. And then the developed countries, the biggest parts of the global stock market, the biggest parts of the global economy, the United States, Europe, and Japan. The U.S. gets less than 1% of its GDP from exporting to China, as we show down at the bottom of page 45. The Eurozone gets less than 1.5% of its GDP from exporting to China, and Japan gets about 3% of its GDP from exporting to China. So a slowdown in China on its own is not enough to sink these big developed market economies. In addition, if you look at page 29 of the guide, on page 29 we just show oil importers and oil exporters. But let's look at the oil importers. Look at countries like India, 5.5% of GDP just importing foreign oil. If oil prices are being held down by a slowdown in China, that's actually a big positive for the Indian economy. It's also positive for the U.S. economy, which is still net an oil importer and net a commodity importer. It is a bigger positive for France and Germany and Italy, which spend more of their GDP importing foreign oil. It's a big positive for Japan. The point I'm trying to make is that there's a lot of mystery about China, but the reality is there is no evidence whatsoever that the Chinese slowdown is hurting developed economies. I mean, it's not. If you look at 44 of the guide, you can see that there is a slowdown in global manufacturing. We show manufacturing PMI indices. You can see how on page 44 down at the bottom right-hand side, you can see all these emerging markets blushing because of the slowdown in the Chinese economy. But if you look at developed countries, they're doing okay. Europe is doing okay. Canada has slowed down a bit, but Australia is doing okay. The United States is doing okay. Japan is doing okay. Overall, even with this slowdown in emerging markets, the developed economies will do all right. The consumers in the developed economies will do all right. And we don't think this means a global recession. It just means a pause for emerging markets here. And then we can move forward and talk a little bit about the U.S. If you turn to page 17 of the guide, you can see the U.S. economy. The little box up on the left-hand side of page 17, we show that quarter-to-quarter growth in the second quarter was 3.9%. That is pretty strong. But I have to say that does overstate U.S. economic growth. U.S. economic growth in the third quarter, I think, is going to be about 2%, maybe even less. Now let's talk about what's going right and what's going wrong. What's going right in the U.S. right now is consumer spending. Consumer spending grew by 3.6% in the second quarter annualized. I think it will go by 3.8% annualized in the third quarter. If you look at page 19 of the guide on the top left-hand side, you can see that the third quarter was an absolute barn burner of a quarter for light vehicle sales in the United States. Consumer spending is doing very well. Housing is doing very well. You can see housing starts continuing to rise on the bottom left-hand side of page 19. Government spending is doing okay. State and local governments still are picking up hiring now recently. Investment spending is doing okay outside of the energy sector. So all of that is actually doing pretty well. And if you look at all of that, you'd say, well, why is the economy doing 3.5% growth? Well, there are three problems. Two of them are temporary, one of them is kind of long-term. The two temporary problems are an inventory cycle and a problem with trade. First of all, let's talk about the problem with trade. The U.S. dollar, it was almost a year ago the U.S. dollar began to soar, and as of the third quarter, it was up about 17% year over year. The problem is we know that increasing exchange rate hurts exports. It just hurts exports with a lag. And last week we got some numbers on merchandise goods exports for August, which are frankly appalling. And if you assume that services exports, even if they did okay in August, you put it all together, it looks like the third quarter of this year we'll see the biggest real trade deficit we've seen in 7 years in the United States. I am no fan of a high dollar. I believe that we are the only pacifists in the global currency war. I think the Federal Reserve ought to have long since taken an active role in trying to stop the dollar from going up so much. But still, what is, and we know that trade is going to take of GDP in the third quarter. It's a problem. You see, global manufacturers have been their output amongst the consumer take and is on services. It's only picking up so much on manufactured goods. And so we entered into the third quarter with a lot of inventory. You can see this on page 19 up in the top right. You can see how the inventory sales ratio has gone up. Now, what we're also seeing in the numbers we see from July and for manufacturing is that we're now beginning to work down those inventories. Inventory growth has suddenly slowed. But as you bring inventory growth down, it does put a drag on manufacturing output. And in fact, we believe the slowdown in inventory growth from about $113 billion annualized in the second quarter to about, say, $60 billion annualized in the third quarter. That will also take a little over 1% out of GDP growth. The bottom line is that if it were not for the trade drag and the inventory drag, GDP growth in the third quarter would be about 4%. I think it would be about 1.8%. So we're seeing a drag there. Now, I will say that those effects are somewhat temporary. Inventories may grow more slowly again in the fourth quarter, but by the time you get below $40 billion of accumulation, you're basically below the long-term growth rate of inventory. So the inventory cycle could be dealt with or two. Even the trade cycle, as long as the dollar doesn't go up anymore, I don't expect trade to deteriorate very badly from where it was in the third quarter. So these are relatively short-term effects. And I think as the economy in 2016, growth will pick up again. So what we're looking for is 3.9% growth is obviously what we got up in the second quarter. I think we will average only about 2% in the second half of this year. But next year we could be at 2.5% to 3% growth as the drag from a higher dollar and from the inventory cycle back off. But we have a longer term problem. If you turn to page 23 of the guide, page 23 shows some aspects of the employment report that we got on Friday. Now, everybody was very disappointed with the employment report. We were too, because when you put together indicator models, they look at a lot of things like unemployment claims and layoff announcements and various industry surveys, and it suggested we should get about 200,000 jobs. We got 142,000. And they revised down the prior 2 months by about 59,000. That is disappointing. It's also disappointing that wage growth was actually negative for the month. It's disappointing the average work week actually fell by a tenth of an hour. But I think we should put this in context. First of all, we've become accustomed to getting 200,000 jobs per month. But if you think about it, 200,000 jobs per month represents a 1.7% annualized growth rate. If the economy is only growing at about 1.8% or 2%, we're not going to sustain 1.7% job growth. We're just not. That means no productivity growth at all. I think productivity growth is low, but it's not zero. And the truth is, if this economy is going to grow about 2% or maybe 2.5%, then we should get used to job growth of about 150,000. That's not really that far off from where we should be. But the other thing to say about the employment report is on page 23, and that is the unemployment rate actually continues to fall. Technically, of course, it's stated at 5.1% in September, but if you take it out another decimal, it went from 5.11 to 5.05. It almost went down to 5.0%. And the reason, and this is the important part, the reason is that labor force fell for the third month out of the last 4. This is not about discouraged workers. Discouraged workers are actually lower than they were a year ago. What's really going on is the demographic and structural problems, which I know I've been talking about forever, which are slowing down labor force growth. The reality is that over the last year, the labor force grew at a monthly rate of 73,000 workers per month. If you look at it from that perspective, we created 142,000 jobs. We really added 73,000 workers per month over the last year. Our job growth is still well above the growth of the labor force, and that's pushing the unemployment rate down, and I think that's going to continue to happen. I think the unemployment rate will stay at about 5% by the end of this year, and maybe 4.9% by December. And then I think it'll be close to 4% by the end of next year. And all that brings us to the Federal Reserve on page 32 of the guide. I should preface what I say about the Federal Reserve by my usual preface on this, which is I realize that the Federal Reserve, unlike other people in Washington, are actually doing what they think is right for the country. I don't question their motives for a moment, but I do think their decision in September was a very bad one. The problem is markets hate uncertainty. They see this weak demand growth and weak job growth as symptomatic of a cyclical problem in the economy. It's not a cyclical problem in the economy. The problem is this economy is just not capable of growing that fast. And the truth is this economy can only run more slowly. Anything over about 2 to 2.5% growth is going to cause this economy to overheat. The fact that the economy is growing at that pace doesn't say that the economy is underperforming right now. This is the economy's potential. And I know the Federal Reserve is worried about what's going on in China, but as I said, I don't think China really negatively hurts the U.S. economy. I know the Federal Reserve is worried about volatility in markets, but what do they think is causing volatility in markets? Uncertainty, and they're contributing to it. Now, I hope they begin to see this. I think the problem with their September move wasn't just that they went out on raising rates in September, but they basically changed the criteria by which they're going to raise rates. They said it's about confidence that inflation is going to head back towards 2% and a tightening labor market. They should have both. But they decided to postpone and wait and see what happens, get a little bit more data. I don't expect them to move in October. They still predict, and you can see on page 32, their dot plot still says 1 rate hike this year and 4 more rate hikes next year. I still think that is possible. I certainly think when they get going, the economy won't slow down. They'll probably speed up, and that will actually encourage them to make further rate hikes. I think the first few rate hikes actually stimulate economic growth. But admittedly, until we get some confidence from the Fed or some certainty from the Fed as to what they're doing, I think that's going to make it tough for the market really to get a sustained rally going. But meanwhile, amidst all this uncertainty and gloom, there is opportunity. And that's actually when the opportunity always occurs. I feel like the only way to find opportunity is to use a flashlight, because it always occurs in a very dark environment. And this is a dark environment, and there is opportunity. If you look at page 4 of the guide, you can see the U.S. stock market sold off quite a lot. It's still up 184% from its low of 2009, but it's fallen a lot. But if you look at valuations on page 5 of the guide to the market is now cheap. As of the 30th of September, the forward PE ratio is 15.1 compared to a 25-year average of 15.8 times. Moreover, the Shiller PE ratio was also below the 25-year average. It might be above its 50 or 75-year average, but it's below the 25-year average. The dividend yield is higher than its average. The price to book, the price to cash flow are below their averages. And the earnings yield is well above the normal spread that it has to corporate bonds. So by a variety of measures, the stock market looks cheap. Now, you could say, well, okay, the stock market looks cheap, but what about earnings? So let's talk about earnings. On page 7 of the guide, we show earnings. And one of the things we did to try and make the story clear is to explain why earnings are weak this year. I mean, this has been a lousy year for earnings. Earnings were down 5% year over year in the fourth quarter, 5% year over year in the first quarter, 10% year over year in the second quarter. I think they're going to be down year over year in the third quarter also. They'll probably bounce higher by the fourth quarter. But it's important to see why this has occurred. First of all, look at the energy sector. If you look up on the top left-hand side of page 7, you can see in the third quarter of 2015, earnings expected about 28.61. And indeed, if you look at the scale, the average quarterly number on earnings is, in the high 20s. Okay, if you look at the bottom right-hand side, you can see the average quarterly number on the energy sector is between 250 and 3. So basically, a tenth. And the energy sector contributes normally 1/10 of the earnings of the overall S&P 500, except in the first 2 quarters of 2015, it gave a new negative number. So right off the bat, if nothing else had happened, the fall in energy earnings on their own would have given you a 10% year-over-year decline in earnings. As I said, we're down 5%, 5%, and 10%. So the energy sector more than explains the drop that we actually saw. But also look at the top right-hand side of page 17. We show the dollar is up 18% year-over-year in the third quarter. What that means is that the inverse is foreign currencies are down about 15% year-over-year in the third quarter. We show that 48% of S&P 500 revenues come from abroad. That's just to make the math easy, assume that, say, 40% of profits come from abroad. Just the dollar translation effect, 40% of profits coming from abroad being hit by 15% depreciation of foreign currency amounts to a 6% hit on corporate profits. So in other words, if it were not for the dollar, were not for earnings and energy, earnings should be up about high single digits year over year throughout this year. And I think that's really what's going on. The Red Sox thankfully finally wound up their season yesterday, and that's it. We're waiting for next year. I think earnings are going to have to wait for next year too. But I think it's important to see that the outlook for earnings next year is quite bright. It looks like this year we're going to be down about 3% year over year, but if the dollar is flat to down and oil is flat to up over the next year, I think we can get double-digit earnings growth next year. But if you're going to invest in equities, where do you invest? If you look at page 9 of the guide, you can sort of see the dilemma. On page 9 of the guide, we show all the sectors, and in the middle of the page, we show the beta of the S&P 500 and the correlation to treasury yield. The main point I want to make is a lot of this depends on your view on interest rates. If you think that over the next year, interest rates are going to go up and the stock market's going to go up, then it's quite clear you should be in financials. Financials have the biggest beta to the S&P 500, and they're also very positively correlated with interest rates. If, on the other hand, you think the market is going to languish and the rates will be flat, then utilities is probably the way you want to go, because they have a negative relationship to treasury yields. And that's really part of the problem. I mean, I think one of the problems the market is facing right now is people don't know what the Federal Reserve intends with regard to interest rates. If you don't know where interest rates are going, you don't know how to invest in equities. You don't know how to invest in equities. You want to wait and see whether you're going to wait in equities. And I think that is one of the things that's holding the market back. If you look at the fixed income markets on page 35 of the guide, I just want to highlight what happened to high yields in the third quarter you can see that the yield on high yield bonds was 8.04% at the end of the third quarter. That's up from 6.5% at the end of the second quarter. So it's been a pretty nasty sell-off. A few things to say about this. First of all, it's not really surprising. You're getting hit by energy and materials in the high yield sector, and also high yield is just the most correlated to the equity sector. So if equities have a bad time, high yield is going to have a bad time. But I do want to emphasize a few things. First of all, high yield bonds are essentially developed, I mean, they're mostly US, but what's not in the US is in other developed countries. If the problem with global economies in emerging markets and commodities, the high yield sector really is not that exposed to emerging markets. The second, if you look at how much the spread to treasuries has now widened out, I mean, if you're looking at yields of 8.04%, you're looking at 10-year treasury yields at 2%, that's 6% of spread, actually even more if you look at this based on the actual maturity of high yield bonds. You would have to have a lot of defaults and very little recovery on those defaults to make that spread sensible. I think the truth is that people ran out of high yield and the market is probably overshot some opportunity. I also find out that there's also in the sell-off that we ran with a lot of dispersion of returns, so there should be some opportunities for active. The main thing I want to say about page 43, this is a really important reason to invest around the world. And we show earnings on the left-hand side and we show PE ratios on the right-hand side. The PE ratios are about at the average level. The earnings, though, for the United States are up close to 30% from their peak in 2007, while earnings for MSCI Europe are down 40%, and earnings for emerging markets are down about 27%. In Europe is growing, but it still has an 11% unemployment rate in the Eurozone. It's got a year of growth ahead of us, and I think earnings will pick up. If you look at emerging markets, we're seeing the effects of a commodity cycle that don't last forever, and I think emerging will pick up. If you turn to page 57 of the guide, we show alternatives, just some basic points about alternatives portfolio that appears to give you a better risk return trade-off. You get risk for giving return, more return for given amount of risk. We also show that over the last 5, 10, 15, and 20 years, private equity has outperformed public markets if you measure private equity by the Cambridge Bad and Growth Equity Index. And then if you look down the bottom right-hand side, hedge fund returns, what we show is they give you downside protection. They don't participate much in the downside in and in fixed income, they tend to also be quite stable sources of return. And I think that this is a market in which it's important to find alpha, it's important to be as diversified as possible. On page 12 of the guide, I just want to say one other thing about volatility. I know you've got clients who are got the volatility we've seen recently. Please use page 12 to this is perfectly normal. It's just a few years since we've seen it. The biggest drawdown I've seen year to date in the third, the drawdown from peak was 12%. Okay. But if you go back over the last 35 years, the average intra-year drop is actually 14.2%. And we show that on page 12. Despite that, actually, equities have given positive returns in 27 of the last 35 years. And we think that's where we are. I mean, I think there's a lot of uncertainty, there's a lot of negativity. I think that the uncertainty is caused by China and it's caused by the Fed. I think over time people will understand the Chinese problem is A, controllable by China to some extent, and B, not that big a problem to the United States or other developed countries. I think with regards to the Fed, eventually they will be good sense to realize that for an organization that wants to be transparent, they're anything but transparent right now, and I think they will try to get their messaging clear. Hopefully they will begin to raise interest rates, which will help people a lot of that, where interest rates go from here, and I think will help the economy. But if we can get past the uncertainty that is controlled by China and the Federal Reserve right now, the sell-off in global equity markets, particularly in the equity markets of developed countries, looks overdone. These economies are in good shape. Valuations are not high. I think there's a lot of opportunity there. I think there's opportunity also in some areas of fixed income, such as high yield and in alternatives. And I think this is a time for people to get back into markets and get invested. Obviously, though, I think this is a time when people need financial advice, both to calm people's nerves so they stay in markets and get invested in long-term assets, and also to look carefully across markets to try and find the best opportunities in what is a pretty gloomy and volatile time.
Thank you, attendees, for your participation. participation. As always, you can reach out to the Financial Wellness Health Center by calling us at 844-ACECRT-8 or emailing us at financialwellness@acecrt.com. I hope that everyone has a great day, and we look forward to our next webinar series with you. Take care.